When this man speaks, trillions of dollars can move across the globe in a matter of minutes. And get this, he's not a president or some big-shot CEO, but he holds this incredible power over the entire economy. So the big question is, how does the Federal Reserve control so much with what seems like so little? Let's break it down.
I mean, just think about that for a second. A few carefully chosen words can directly mess with your retirement savings or change the price of milk at the grocery store. It's this incredible level of power that really affects every single one of us, which is why understanding it is so crucial.
So, yeah, that's the real question, isn't it? How does this whole system actually work? What is the secret sauce, the actual mechanism that gives one person this kind of leverage over our financial lives? Well, it's time to pull back the curtain.
The answer, believe it or not, isn't some crazy secret formula cooked up in a lab. It really just boils down to one of the most fundamental concepts in all of finance. It's like a single lever the Fed can pull to either speed up or slam the brakes on the entire economic engine.
And that lever is interest rates. I know, it might sound a little dry, but trust me, this one concept is the absolute key to unlocking how the Fed shapes our world. So let's get into it. To really get this, we gotta strip away all the complicated jargon. At its heart, an interest rate is, well, it's simply the price of money. Just think of it like this. If you want to use someone else's money for a little while, you have to pay a small fee for that privilege, right? Well, that fee, when you put it as a percentage, that's the interest rate, plain and simple.
Okay, here's a super simple way to look at it. Let's say you borrow $100 from a friend. Later, you pay them back $105. That extra $5, that's the interest, which means the interest rate is 5%. This exact same principle applies to literally everyone, from you and me to the biggest companies and even entire governments.
All right, so we get what an interest rate is, but why on earth does a tiny little change in that rate cause these massive waves in the stock market and the whole economy? Well, it all comes down to borrowing and incentives. See, it works like this. Companies are always borrowing money to grow, to build new factories, hire more people, that sort of thing. So when interest rates are low, borrowing is cheap, and that encourages a ton of growth, which of course investors absolutely love, and that often sends stock prices soaring. For investors, it's all about making a choice. Think of it like a seesaw. When interest rates are high, super safe investments like bonds suddenly look really good. Why would you risk your money in the stock market when you can get a solid, safe return? But when rates are low, those same safe options pay next to nothing. The seesaw tips, and suddenly the stock market's potential for bigger returns looks way more attractive, and a flood of money flows in. Now, the Fed doesn't just wake up one morning and shout, "The interest rate is now 3%. No. Instead, it uses a very specific set of tools to influence rates across the whole economy. Let's take a look at the main four. So here they are, the four main tools in the Fed's toolbox. Each one works a little bit differently, but they all share the exact same goal: to nudge the cost of money, the interest rate, either up or down. Okay, the big one, the most important tool by far is the federal funds rate. Think of it like a stone thrown into a pond. It's the rate banks charge each other for super short-term overnight loans. By targeting just this one rate, the Fed creates a ripple effect that spreads across the entire financial pond, affecting everything from your mortgage to your credit card rates. So how does the Fed actually control that key rate? Well, mostly through something called open market operations. And it's actually pretty clever. When the Fed buys bonds from banks, it's basically injecting a bunch of cash directly into the banking system. More cash floating around means lending gets cheaper, so rates fall. And when it wants rates to go up, it just does the opposite. It sells bonds, which pulls cash out of the system. Next up, you've got the discount rate. You can think of this as the emergency loan window for banks. If a bank is in a pinch and can't get the cash it needs from another bank, it can go straight to the Fed. It's usually a bit more expensive, so it really just acts as a safety net, a backstop for the whole financial system. And finally, there are reserve requirements. This is just a rule that tells banks how much cash they have to keep on hand versus how much they can lend out. Now, in theory, changing this is a really powerful, kind of blunt instrument to control the money supply. But in practice, the Fed really hasn't used this tool much at all in recent years.
So all this sounds pretty good in theory, right? But how does it actually work in the real world, especially when things go totally haywire? Well, there's no better example than the 2008 financial crisis, which put the Fed and all its tools to the ultimate test.
Just look at this timeline.
Before the crisis hit, the Fed's key interest rate was sitting around 5%. Then, as the crisis exploded and panic spread like wildfire, the Fed acted, and fast. They started cutting rates again and again and again, until they were slashed all the way down to basically zero. The goal was to make money as cheap as possible to stop a complete and total economic meltdown.
But here was the terrifying problem. The entire financial system was so frozen with fear that even with interest rates at zero, banks were still too scared to lend money. The Fed had used its main weapon, its biggest gun, and it just wasn't enough. They had to pull a rabbit out of their hat.
And this, right here, is where we all learn the term quantitative easing, or QE. You can basically think of it as open market operations on steroids. Instead of just making small tweaks, the Fed started buying trillions, with a T, trillions of dollars in bonds, just flooding the system with cash to force long-term interest rates down and get money moving again. It was a totally unprecedented move for a totally unprecedented crisis.
Look, there's no doubt the Fed's actions back in 2008 helped pull a system back from the absolute brink of collapse. But it also leaves us with this huge, looming question for the future. After using such powerful and frankly unconventional tools, what's left in the toolbox for the next time a big crisis hits? That's a question that economists and policy